You've tuned in to Talk Tickers, your direct line into the crucial takeaways from the latest earnings calls. Today, we're diving deep into the Q2 2025 earnings call for Bioventus, ticker BVS. They're a company making some, well, genuinely interesting moves in the medtech space. You sent us this call. And what really jumps out is how the market reacted. On the surface, looked like maybe a slight miss. We've got a lot to unpack here, from their headline numbers to, the strategic shifts catching investor eyes.
Indeed. This call, August 6th, 2025, it really offers a fascinating look. You've got a company navigating sector headwinds, sure, but also cultivating some very compelling organic growth. And the market reaction, definitely strong. It often signals confidence, right? Even when the numbers aren't perfect straight off the bat, makes you look deeper.
Absolutely. So let's pull back that curtain, kick things off with the headline numbers. Bioventus reported GAAP EPS of 0.11 cents. Now, GAAP, generally accepted accounting principles, the standard way they report earnings per share, that's 0.11 cents, is a big improvement. I mean, compared to negative 40 cents last year. However, their non-GAAP EPS, that adjusts for one-time things, gives a clearer operational picture. That came in at $0.21, just a slight miss against the consensus, which was $0.22. Revenue also a slight miss, $147.7 million, but it's about $148.1 million consensus. So yeah, bit of a mixed bag at first glance.
That's right. And this is where the deep dive really starts. What's crucial, despite those minor misses, is the underlying strength. Management really hammered this home. Overall revenue, yes, down 2.4% year over year. But, and this is key, that's largely due to divestitures. Selling off parts of the business, strip that out, strip out FX, and you get a robust 6.2% organic growth. That's the core business performing well. That's the story. And adjusted EBITDA earnings before interest, taxes, depreciation, amortization, a good measure of operational profit, around $33.8 million. That's like a 23% margin. Management called it cure leading. Strong signal. But maybe most compelling, especially now, operating cash flow. Big boost, up 71% year over year to $25.9 million. That's strong cash generation.
It's not just a number, it's, well, strategic.
That's a huge distinction, isn't it? That's 6.2% organic growth, especially against the, the headline decline from selling stuff off. It really suggests a deliberate strategy. So, okay, unpack this organic growth. Where's the strength coming from? What's driving the profit in that cash flow improvement? Well, what's fascinating is this deliberate portfolio mix shift they're executing. Think of it like pruning the garden, right? Let the strong plants flourish. They're shedding lower growth stuff and focusing on higher potential areas. Two key drivers: surgical solutions and restorative therapies. Surgical saw strong double-digit growth in ultrasonics bone healing tech. And bone graft substitutes are accelerating. High single digits in Q2, up from low singles in Q1. They see that continuing. It's a trend. Then restorative therapies. Their Exogen product uses ultrasound for fractures, accelerated to double-digit growth this quarter. Management thinks they can keep that going, mid-single to double digits. They're aiming to get that business back over $100 million. How? Focusing on the market size, getting more effective commercially, getting it into more doctors' offices. Even pain treatments slowed a bit because of tough comps from last year, but they expect acceleration in the second half, especially with Durolane driving that shift to single injections. Simpler for patients. It shows they're really optimizing.
That strategic focus really paints a clearer picture. Higher growth, higher margins. Makes sense. And speaking of pain treatments, here's where it gets really interesting. They talked about a big new opportunity. Peripheral nerve stimulation, PNS. Sounds like a potential game changer. Tell us about that.
Yeah, this really answers the question about future growth beyond what they already have. It's a strong answer. Bioventus got 510K clearance for STIM trial and Talisman for PNS. Now, 510K, that's the FDA pathway for devices similar to ones already out there, faster to market. And this is huge because it targets chronic peripheral pain, a big problem, right? People want non-opioid solutions. The market, growing over 20% a year in the US. Total addressable market, maybe $2 billion by 2029. That's a massive pie. And Bioventus sees a clear path to a $100 million plus opportunity here. They're not just entering, they think they have advantages. Patented tech, integrated generator, designed for deeper nerves, could simplify things for doctors. And STIM trial, their first trial lead. That's key. Doctors often need to test effectiveness before implanting something permanent. Plus, payers, insurance companies, some require trials for reimbursement. This streamlines it all. They're planning a limited launch, select U.S. markets, Q3 2025. Broader rollout, early 2026. So yeah, it's not just a product. It's a substantial non-opioid solution, shows real R&D muscle.
Okay, so not just incremental, a whole new growth engine, potentially. Given all this, the organic growth, the strategy shifts, this exciting PNS launch, the natural question, especially for you listening, is probably, what's the outlook? What's management expecting for the rest of the year? Did they update guidance to reflect this optimism?
They did, and their confidence was, well, you could really hear it. Management emphatically reaffirmed their full year 2025 guidance, which, after those slight headline misses, that's a powerful signal. They expect revenue $560 to $570 million, organic growth between 6% and 8%, adjusted EBITDA $112 to $116 million. That implies margin expansion, at least 100 basis points year over year. 100 basis points is a full percentage point jump in profitability margin, strong signal on efficiency, non-GAAP EPS guidance, also firm, $0.64 to $0.68. And what's maybe even more telling, this guidance already includes about $5 million in headwinds, FX and tariffs for the year. About $2 million FX hit already absorbed first half, maybe $3 million tariff impact second half. It shows they can manage through macro pressures and still hit their targets. Not easy in today's world.
That is a robust outlook, especially factoring in those headwinds. It sounds like they're really hammering financial discipline too. That cash flow point you made earlier, how's that playing into the broader financial strategy?
You nailed it. Critical point. Cash flow from operations. Expected to nearly double compared to 2024. That's a massive leap. They're using that cash. Reducing debt. Aiming for net leverage below 2.5 times by year end. Lower debt means less interest expense, frees up capital. Right. And they were proactive. Refinanced their credit facility. Lowered interest rates by 75 basis points, 0.75%. Saves over $2 million a year. The new deal also extends maturity to 2030 and increases their revolver, that's like a flexible credit line, by $60 million up to $100 million. Increasing it by $40 million adds a lot of flexibility, frees up capital, reduces annual debt repayment needs by $15 million. So it's the whole picture, isn't it? Strong growth, efficiency, solid balance sheet. The narrative is shifting from stabilization, that was a theme before, to measured acceleration, driven by organic growth, cash generation, and these new product lanes like PNS. R&D is ramping there now. Plus, they're managing operating expenses to grow slower than revenue. Helps that margin expansion, too.
It's a compelling story. A company taking control. You mentioned the market reaction, stock up almost 19% on the day, despite the slight headline misses. For our listeners, what do you think that really signals? Why should they care about these details beyond just, the stock price move?
Right, connecting the dots. That big rally suggests investors, like us, maybe looked past the minor stuff. They prioritized the reaffirmed guidance, the strong underlying organic growth, that cash flow acceleration. And remember, the stock hit a 52-week low right before this call. Expectations might have been kind of low. So this call really demonstrated execution, the portfolio mix shift, the efficiency story. It's happening. Now, the broader med device sector, look at an ETF like IHI. It's lagged the S&P 500, faces its own FX tariff issues. But Bioventus's specific catalyst, their discipline management, that seems to be differentiating them. Focusing on higher margins, strategic bets like PNS, it provides a clearer path for value creation. PNS alone, plus their new PRP platform, could add maybe another 200 basis points of growth next year. So what this signals to you, listening, is that even in a tough sector, companies with strong execution, clear innovation, disciplined finances, they can stand out. They can potentially outperform. It's about finding those unique stories within the broader trend.
Okay, disclaimer time. The following segment. Speculative trade ideas, absolutely not side of financial advice. Always do your own research, your own due diligence. All right, with that said, given Bioventus' Q2, the outlook, especially that huge PNS opportunity laid out, what's a wild but, plausible trade idea you might pitch, hypothetically?
Okay, let's brainstorm an outrageous but plausible play here. You've got this SMED 8-cap med tech company, right? Small to mid cap, been under pressure, hit that 52-week low, then it surges nearly 19%. Why? Strong organic growth, compelling new stuff like PNS. Meanwhile, the broader sector, IHI, XHE, whatever ETF you pick, it's lagging the S&P. So my pitch, maybe a long position in Bioventus using out-of-the-money call options. Out-of-the-money calls, they give you the right, not obligation, to buy higher than the current price. Leveraged upside if it moves up big, but simultaneously maybe a short position in a broad medical device ETF like IHI or XHE. Shorting means betting the price goes down. The rationale, it's a relative value play. We think BVS's specific drivers, the portfolio shift working, Exogen turning around, and critically, that multi-year, 100 million plus PNS opportunity let it significantly outperform its lagging sector. The calls give you that leveraged pop if the BVS story really plays out, while the short ETF acts as a hedge. A sector hedge against macro stuff, FX, tariffs, maybe September market wobbles, So it's not just betting on BVS.
Right.
It's betting BVS will do better than its sector peers because of superior execution, a differentiator play.
That's a fascinating strategic angle. Really highlights the power of digging into the specifics, doesn't it? And that's a wrap on our Talk Tickers deep dive into Bioventus' Q2 2025 earnings. We've seen a company showing strong organic growth despite those divestiture headwinds, dramatically improving cash flow, and outlining a really significant new product opportunity in PNS that could, well, redefine their future.
Yeah, their reaffirmed guidance, the disciplined financial management, debt reduction, stronger balance sheet, it definitely caught the market's attention. Shifted the narrative from stabilization to kind of measured, confident acceleration. And just a reminder, everything here, informational purposes only, not financial advice.
And here's something maybe to chew on. In this environment where so many companies are just trying to stay afloat, dealing with macro stuff, how much extra value should we maybe place on a company that not only navigates that, but actively builds new growth engines? It kind of challenges that idea that the whole sector moves together, right? Thanks for tuning in to Talk Tickers. Found this useful? Send us your thoughts. Suggest the next call you want us to unpack. Until next time, stay informed.